Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis and a warm welcome to Money Talk for Thursday the 5th of September. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, US job openings, a proxy for labour demand, fell to the lowest level in more than 3 years in July, keeping the Federal Reserve on track to lower interest rates later this month. There were 7.7 million job vacancies in July, according to the Labour Department's Job Openings and Labour Turnover Survey, known as JOLTS, released on Wednesday. That was down from 7.9 million in June and the lowest total since January 2021. China's services activity expanded less than expected, a private survey showed, adding to worries over the economy's health. The Caixin China Services Purchasing Managers Index fell to 51.6 in August, compared with 52.1 the previous month, below market forecasts of 52.2. It was, though, the 20th month of growth in services activity. The Washington Post is reporting that President Biden is preparing to announce that he will block the takeover of US Steel by Nippon Steel. US Steel CEO David Barrett told the Wall Street Journal the company would likely close plants and move its headquarters from Pittsburgh if the deal is blocked. Mr. Barrett said that the transaction is crucial to keeping US Steel's older plants competitive and maintaining jobs. The report comes after Vice President Kamala Harris said US Steel should remain American-owned and American-operated. Stock markets in Asia tumbled Wednesday on fears that the US economy could be heading into a recession. Stocks in Japan and Taiwan led the losses. Japanese stocks were hit by a double whammy of sliding tech shares and a stronger yen. The Nikkei 225 was down 4.2%. In Taiwan, the TAIEX plunged 4.5%, having been down as much as 5.3% in early trade. South Korea's Kospi lost 3.2%, dragged lower by semiconductor stocks. Joining me this morning to discuss the latest headlines as markets open around the region are Andrew Freris, the CEO of Ecognosis Advisory, and Michelle Lam, Greater China Economist at Societe Generale Corporate and Investment Banking. And with a view from Taiwan is Ross Feingold, Director of Research at Caerus Consulting in Taiwan. And this morning's Asian Business newsletter is now available at peterlewismoneytalk.substack.com. US stocks stabilised Wednesday following Tuesday's steep sell-off and ahead of Friday's crucial jobs report. The S&P 500 booked back-to-back losses as Wall Street grapples with another rocky start to the month. The benchmark index lost 0.2% to finish at 5,520. The Dow edged up 38 points or 0.1% to end at 40,975. The Nasdaq Composite slid 0.3% to close at 17,084. Wednesday's moves came after the indices notched their worst session since the global market rout in early August. Shares of Nvidia slid 1.7% as traders continue to offload the stock after the Department of Justice subpoenaed the chip maker on Tuesday. The move comes after Nvidia tumbled 9.5% Tuesday amid a broader pullback in semiconductor stocks. Shares of US Steel plunged 17.5% on a report in the Washington Post that President Joe Biden is preparing to announce that he will block the $14.9 billion takeover of US Steel by Japan's Nippon Steel. Treasuries rallied following economic data that indicated a slowdown in the US labour market. The yield on the 2-year Treasury fell 12 basis points to 3.77%, its lowest since May 2023. The yield on the 10-year note dropped 8 basis points to 3.76%, and the dollar index fell 0.5% to 101.27 on Wednesday, trimming its rebound from the 14-month low of 100, which was touched on August the 19th. The yen surged 1.2% against the dollar, ending at the day's highs of 143.76 per dollar. Spot gold rose 0.1% to $2,495 an ounce. Crude oil prices fell to their lowest point of the year on Wednesday, as concerns that weak Chinese demand would lead to a surplus on the market. Brent futures were down 1.4% at $72.70 a barrel. Bitcoin fell 1/3% to just above $50,000 $57,900. Mainland Chinese and Hong Kong indices saw smaller declines compared to other markets in the region. The mainland CSI 300 saw the smallest decline in Asia, down 0.7%. Hong Kong's Hang Seng Index slipped 194 points, or 1.1%, to a two-week low of 17,457. Oil producers suffered the steepest losses in Hong Kong after oil prices dropped. PetroChina plunged 6.1% and CNOOC sank 6.4%. Futures markets pointing to a small rebound in the Hang Seng this morning at the open of about 70 points. The index projected to start the day at 17,530. And don't forget, you can get plenty more details on all of those market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our regular Thursday morning commentator, Andrew Freris, the CEO of Ecognosis Advisory. Morning, Andrew.
Good morning, Peter.
And also with us, Michelle Lamb, Greater China Economist at Societe Generale Corporate and Investment Banking. Morning to you, Michelle.
Good morning, Peter.
China's services activity expanded less than expected, a private survey showed, adding to worries about the economy's health. The Caixin China Services PMI fell to 51.6 in August. That's down from 52.1 the previous month. Also below economists' forecasts of 52.2. It was the 20th month of growth in services activity, supported by rising new business and new orders amid better demand conditions, with foreign demand growing faster. On prices, inputs cost inflation accelerated to the highest level since June 2023, which was boosted by higher material, wages and transportation costs. Meanwhile, output costs fell for the first time in 7 months and at the steepest pace since April 2022. Andrew, we've had all four PMIs now, the two from the National Bureau of Statistics and now the Caixin PMIs on both the manufacturing and services side. People seem to be a little bit gloomy about the outlook for the Chinese economy. What do you think all of this data is telling us?
Well, I would add to that the PMI indexes are indexes of expectations. They're not indexes of actual output, and as long as they are slightly above 50, they are basically okay. So I would not hasten to say that things are looking significantly worse, because Caixin and the official index, of the four of them, if I remember well, three of them are above 50, so although declining. So the answer is yes, they are not improving, but they are not getting worse in terms of pure statistical measurements. The thing that concerns me, of course, is deflation in China, which is now a reality. CPI is near zero, and the WPI has been declining for, I've forgotten now, a year and a half plus. And my favorite index, which is the 70 major and minor cities in China, the prices of new homes, okay, it has been declining negatively. Okay, it has been, all right, to use the word deflation, for nearly 2 years now, and with no sign of improving. The July number was bigger than the June number. It went from 4 to 5% minus. So it is really the performance of prices, which is a symptom, not a cause, okay, of the malaise. So in other words, if you're saying the economy is not feeling very well, what is a symptom of that? And that is that prices are falling.
Okay. Michelle, several investment banks have now cut their China GDP forecasts. Analysts seem to be becoming increasingly sceptical Beijing is going to reach its 5% economic growth target. What about you and SocGen? What are your forecasts for China's economy? And do you think it's going to meet this 5% target?
Actually, last week we've already lowered this year GDP forecast from 5% to 4.8%. So we are getting more skeptical that whether China will be able to meet this year's growth target, given that the second quarter GDP was not great. And actually in July and August, looking at the activity data and the PMIs recently, it seems that So first of all, for the manufacturing PMIs, I know that there are probably some weather factors related to the severe rain and the hot weather, but it seems that even in August, this factor just remain in place. But even looking at the new orders and what Andrew referred to, the expectations, it doesn't seem that the orders are picking up. So I feel that it's definitely getting more challenging for the policymakers to deliver, and actually for the growth this year, the exports have been doing great, and going into July, I think we are seeing some softening signs, and it is not clear that whether the exports could be continued to keep growing, because the first half was already very strong. So going into the second half, we are now seeing some softer signs from the US side. So it could be that the global demand could be softening, which is not helpful for China's exports. That's the first thing. And in terms of the domestic demand, right, we know that consumption is going to be very, very sluggish because of the property problem. But even on the capex side, I think this year, in the March budget, the government announced 1 trillion special CGBs to support the infrastructure. But even for that, we are not really seeing the infrastructure investment picking up a lot. And I think that's a lot of that is to do with the local government that's leveraging. Yeah, some news reports suggesting that the issuance of the bonds are actually used to repay the implicit debt. So actually, there may not be much of a thrust for infrastructure capex to pick up in the coming months. So we're just getting increasingly skeptical that whether the policymakers will do enough to meet the growth targets.
Do you get a sense that sort of pessimism is taking hold now among domestic companies and major importers on the mainland?
So it has actually been a case since the reopening last year, and when we speak to businesses, investors, in particular in the onshore markets, they are always pretty pessimistic. But I think right now it's just that the situation seems to be getting worse, because people simply do not expect the situation to recover soon. So definitely, I think there is a kind of the debt deflation spiral increasingly starting to take hold.
So, Andrew, what's to be done? Does China need to go and enact some sort of mid-year budget expansion? What can they do?
Fiscal policy-wise, they have already done quite a lot, in the sense that, if you remember, about 3 months back, they produced a new set of borrowing targets in terms of several billions of renminbi that would be available for the funding of infrastructure. Fiscal deficit in China can easily expand, because first, China is a net lender to the world, it's not a net borrower, and the fiscal deficit in terms of percentages of GDP, that can vary anything between 3.5% to 5.5%. It is quite low by any other measurements and standards. But then, of course, the question is what they're going to do with the money. Clearly, they are unwilling to create a bad bank and clear out the debts of the private sector property companies. They are unwilling to do it, and I can definitely see the point of why they should be spending people's money to right wrong decisions made by the private sector. But whilst this is happening, prices of properties continue to fall, and that is extremely poor in terms of a sentiment supporter for the average Chinese middle class family, where their major investment in assets is property. So they are caught, to the extent that they have done a fair amount of boosting liquidity and boosting actual spending by the local authorities on, let's say, buying properties and then selling them off for, let's call it popular housing, whatever that means. And I have not seen, this might be just ignorance, I have not seen any specific progress on that. In other words, how is this initiative has been going? So given the reluctance of the Chinese authorities of anything significantly novel or significantly wild, or even doing a 2008 performance of the Western economies. In other words, really going full out to support the economy, then I can't see what else they can do.
Michelle, what can be done? Does there need to be some sort of fiscal expansion here to try and get China out of its malaise?
So I agree that China really needs something radical to support the property markets. So I think among all the things, right, you can do fiscal policy, monetary policy to support the economic growth. On the fiscal front, so you can talk about cutting taxes, but the fiscal revenue is already very poor for China right now, given that the land sales has collapsed. So there's actually not much appetite for do that, and it's also not practical from the government's perspective. On the infrastructure front, they're already doing some, and I think that there's some funding budgeted for that, but I think actually the implementation has been too slow. So I think it's possible it could be that they could repeat what they did last year, which is to announce some special CGBs, so basically more funding to support the local government to do the infrastructure. But I think right now this year, what we have been seeing is that the transmission channel has actually been impaired because the local government, they are also fixated on that deleveraging themselves. So I think more central government funding will help, but it needs to be very aggressive. So in terms of monetary policy, I think probably maybe not much of an impact on markets and expectations, and because the PBOC has been sticking with a very gradual approach because of the concerns of the bank interest margins and FX stability. And I think borrowing from Japan's experience, right, even cutting interest rates when you are in a liquidity trap probably will not help revive private sector confidence that much. So I think among other things, actually, the most important part is to stabilize the property sector. So the government has been announcing some measures like the stocking scheme that Andrew talked about, and the implementation has been slow. So I think there are probably some discussions going on how to make the scheme more effective, such as, for example, maybe the local governments can issue special local government bonds to help with the destocking program. So basically, the existing design of the scheme is that it's just local SOEs using their own money to support the scheme. But at the end of the day, they also have the debt sustainability concern. So if we have the local government money coming in, that may be able to provide more firepower to the scheme. But that remains to be announced by the government. So at the end of the day, I think really we actually need fiscal or PBOC money to actually help provide more support to this housing destocking scheme, and hopefully that could be able to put the housing prices on a stabilization trend instead of just continue to be falling as we're seeing right now.
Andrew, are you seeing signs that this sort of economic chill from China is spreading around Asia in the PMIs we've seen elsewhere? I mean, Taiwan, it did ease for a second month. Indonesia has fallen now into contraction territory for a second month. Is this sort of gloom from China, is it spreading?
Basically, no. Okay, because China is an important trading partner, and if it would have any specific impact, that would have been mostly in the case of South Korea and perhaps of Taiwan, but actually to look, for example, at Indonesia, or to look for that matter in Australia, and say that GDP growth in Australia has just come out and was slower, that it has been caused by China is a little bit of an exaggeration. Okay. However, in the case of Hong Kong, where I had just finished a very detailed analysis of the economy, it's a kind of a mirror image to China. There is nothing specific to worry about. I'm not saying I'm looking at the Chinese numbers and my God, if they continue like that, we're going to have a major problem within 6 months. Absolutely not. But it's not getting better. And it is too many little things as opposed to a small number of very important things going south that it is affecting China. And so is the case of Hong Kong. For example, property markets, every single index that you can think of both absolute prices, percentage change in prices, and also the rentals have been going south, except one or two indexes, for more than a year now. And there is no end to that. There doesn't appear to be something finishing. Also, Hong Kong doesn't have an inflation problem precisely because the rate of inflation in Hong Kong is also low. And then we have the indexes or the PMI indexes also pointing southwards. Then we have retail sales not doing very well. So if I was to put the two things together, they seem to match a great deal. And of course, Hong Kong's external sector is totally dependent, exports and imports, totally dependent on China. And China is not doing well. And if it is not doing well, then Hong Kong's exports, of which 95% are all re-exports, and of which this 95%, more than half of it, are re-exports to and from China, are not doing well also. And of course, it definitely reflects it. But then Hong Kong is a very special case. Never mind, of course, the fact that tourism in Hong Kong has not made at all a post-COVID recovery. It is floating around half the amount of tourist visitors, a little bit more than that. At the peak, we had about 65 million, and now we're looking at about 40 million visitors. Which is okay, which is good, but still 20 million is missing. And it doesn't look as if it's going to appear from nowhere. And of course, tourist trade in Hong Kong is, I would say almost exclusively, it is primarily tourist trade with China. And this is not improving. This is not improving to the level that it used to be before.
Michelle, let me ask you for your thoughts on Hong Kong. The PMI showed business activity here contracted for the fourth month. The PMI fell to 49.4. Any signs at all of a turnaround in Hong Kong?
I think for the Hong Kong economy, of course, you talk about the retail sector side, right? So there's definitely the factor of the economic slowdown in China that is affecting the tourists coming to spend on luxury goods in Hong Kong, which has been actually one of the key drivers for the retail sales in the past. That's one. And also, you are seeing the locals. They're also maybe a bit hesitant to spend too much money on the local economy, and that's because if you just cross the border, just 20 minutes by taking a high-speed rail, you'll find out that the goods restaurants in Shenzhen is just 1/3 of the price of Hong Kong. So why bother spending so much money when for celebratory events? So I think to some extent that also helped to explain why the retail sales has been so sluggish in Hong Kong. So I think that's also one of the key factors. And aside from the retail sector, you look at the overall business situation. I think probably the trade and logistics sectors are doing a bit better this year, given that, if you look at the China trade numbers, exports are doing better, and that's also the case for the rest of the Asia. So Hong Kong should also benefit from that. But if you look at the business sectors like professional services, you've already had the lingering impact of the very weak capital market activities. Like you look at the IPO numbers in Hong Kong, it just continued to be very low because of the lack of confidence in the mainland markets. And of course, I think earlier this year, you also saw that the CK asset, they're also preparing for secondary listing in the London market. So I think that just highlights that the lack of maybe large turnover or the investors' interest in the foreign investor interest in the Hong Kong market. That I think that is a warning sign that for the policymakers to think about how to deal with this. Increasingly, I think the structural weakness for the capital markets for Hong Kong. So it's just getting challenging.
Let's turn our attention to the US. Andrew, we had some data overnight from the US in the form of the JOLTS survey. That's the Labour Department's Job Openings and Labour Turnover survey. And that comes ahead of the main jobs report on Friday. But the JOLTS survey showed that US job openings, which is a proxy for labour demand, fell to the lowest level in more than 3 years. In July, there were 7.7 million job vacancies, according to the survey, down from 7.9 million in June. The number of job quits also edged up, which is a sort of another measure of a weakening job market. Andrew, you were very clear last week. The Fed is not going to cut interest rates this month in 10 days' time. Are you still confident of that, even after this latest labour market data?
My confidence, if anything, are actually look. It is a voice in the desert, as they used to say about the prophet John. It was a very biblical reaction. I'm not doing this in order to be contrarian, because that's completely stupid. I don't want to be wrong, but equally, I don't want to be early and wrong, as opposed to being late and right. And what absolutely amazes me, it is the inconsistency by which numbers have been used, to the point that now we're looking at non-farm payrolls, which the last number in July was 114, it was down from June 179. And this was the famous number that they were wrong by a factor of 880,000, okay, just a couple of months before on the year basis. Now we are hanging on to those, whether they're going to go up. And also, now, I'm sorry, I'm going to take 1 minute, because that made me absolutely furious. The PCE number, that apparently it is the blue-eyed baby of the Fed, is completely all over the place. It really doesn't provide any firm evidence that inflation is coming down firmly towards the 2% target, which apparently has been thrown out of the window. So let me just read you the PCE, okay, numbers for May was 2.6, June 2.5, July 2.5. Inflation is steady. Yeah, it has declined a little bit, okay, and then the core PCE has actually gone up. They produced the most amazing number of inconsistency numbers till they finally got it right, very quietly. Okay, they kept erasing the numbers that have been released. And the correct numbers now, May, the core was 2.5, June 2.5, July 2.6. It accelerated. So on that basis, how can I possibly turn to the Fed and say, that's the numbers you're relying on? Now you have changed your mind and you're going to stick on some unbelievably unreliable numbers, and these are the non-farm payrolls, to cut interest rates. I congratulate you. So, yes, of course, they may very well cut interest rates, but I would say on the basis of what they are telling us, not what I am telling the world, okay? And they keep changing the things. Then, of course, they will be insane to cut interest rates on the basis of the numbers they are telling us they're using. Very good.
I mean, what you're saying really here is that the data doesn't support an interest rate cut. The Fed really shouldn't be cutting rates. However, Jerome Powell seems to have laid his hand on the table already and pretty well said that they will do it in September. So it's going to be a bit hard for them to back down now, isn't it?
No, because they've got the safety valve of saying we will act depending on the numbers we're seeing. I'm not saying I'm keeping my fingers crossed, but if the non-farm comes out at a large number, they will say, okay, let's wait for 1 more month.
Michelle, what are your thoughts here? I mean, the consensus in the market seems to be that inflation is under control and the jobs market is weakening, and therefore the Fed needs to cut. What do you think?
I think if the Fed doesn't cut in September, it will be a big shock to the market, even though we could be seeing stronger of a non-farm payroll as we expected.
Okay, so you think they will have to cut?
Just look at So this Friday's NFP number will be very crucial. But having said that, I think the current moderation in employment trends look to me is a normalization from the post-COVID boom, rather than signaling some serious weakness in the U.S. economy. Which you look at the GDP numbers, it's still suggesting the economy seems to be doing okay, maybe not so strong as we've seen last year of a whole overheating, but it's still in the rather the neutral position, I think.
The Atlanta Fed GDP Now tracker, it was revised lower after the latest data, down to 2% from 2.5%. So clearly showing the economy is slowing. But nevertheless, 2% is not a bad number, is it? I mean, there's really not any sign of a recession on the horizon.
No, but maybe the argument for rate cuts is actually the rate, the position of the neutral rates of interest. So the Fed definitely thinks that the current policy rate is just too restrictive, and there's actually some room to bring it down to a level that may be still restrictive enough to bring inflation down. But given that we are also seeing some signs of a slowing in the labor markets, but of course, this level of neutral interest rate is a very ambiguous concept. Economists, they try to model it a lot with a lot of complicated models, but it's a variable that we can only observe it after the event. So that's just highlight a lot of uncertainty when what the Fed is going to do about cutting the interest rate. So I think it's going to be very gradual. I don't think I'm in the camp that the Fed should be reacting very quickly to any weakening in the labor market data, at least.
And what would be the impact of a rate cut on Hong Kong, where clearly we're a dollarized economy? What's the impact going to be here and on the Hong Kong market, do you think?
Well, so if the Fed rates are really happening, depends on the scope, right? If we're talking about maybe 1 percentage point of a cut, then and even 2 percentage point could be somewhat helpful to the property market, especially on the residential. But I think there is a lot of a problem still with the coming up supply in the retail market, and I think the commercial market, talking about the office and retail, there's still a kind of the economic weakness waiting on the rents, which require the asset prices in the business sectors to be written down. So I think that could be somewhat supportive of the retail, but maybe still not so much on the business side. And also I don't think, and given the interest rate cuts, if it is modest, given it could be and which is still possible, given that maybe the inflation problem is actually more persistent than what people are thinking, then in that case, if the Fed just cuts maybe 50 basis points, I don't think that's going to really change the home buyer's mind about getting into the housing market now.
Andrew, final thoughts from you on the market. We've had another bit of sell-off at the beginning of this month, following the one in August. But what was very noticeable was Hong Kong markets, mainland China markets, very much outperformed in what was a sort of a global sell-off, particularly in chip stocks, particularly here in Hong Kong. Do you think that's going to be a trend that's going to continue? We're clearly going to see a lot of volatility in the markets, but has the damage already been done here in these markets, and therefore they're going to outperform?
Well, simply looking at 10 Asian markets, excluding Japan, 3 of them, in other words, China, Hong Kong, and Korea, year to date, they're down. In other words, they're underperforming. The rest of them are doing all right, but then they are very small markets. So, pointing out that perhaps Singapore, Malaysia, and Thailand also is not doing very well, are doing okay. That is very good, and very happy about that. But really, that doesn't change anything when one looks, in inverted commas, at the global markets. And the funny thing is the worse the U.S. economy is expected to do, the more the markets sell off, despite the fact that means a guaranteed cut in interest rates. You can't. It's absurd. If, for example, we were to get a spectacular non-farm payrolls on Friday, but a really big one, and the Fed says, well, perhaps we're not going to cut, the markets will immediately also collapse again. So it is a pretty thankless task, and that's why my advice to my clients is don't do anything with the U.S. equities until and when the elections are out.
Mm-hmm. Okay, well, interesting thoughts. Thank you very much. Andrew Freris, the CEO of Ecognosis Advisory, and Michelle Lam, who is Greater China Economist at Societe Generale Corporate and Investment Banking. I'm joined now by Ross Feingold, who is Director of Research at Caerus Consulting in Taiwan. Morning, Ross.
Good morning.
Now, the Washington Post is reporting that President Biden is preparing to announce that he will block the takeover of US Steel by Nippon Steel. US Steel CEO David Burritt told the Wall Street Journal the company would likely close plants and move its headquarters from Pittsburgh if the deal is blocked. And that report comes after Vice President Kamala Harris, the Democratic presidential nominee, said US Steel should remain American-owned and American-operated. Ross, how big an issue is this among workers in America?
Well, it's a huge issue, especially since we're in election season. People look at steel as a core industry. They want it to remain American-owned, even though the acquirer in this case is from one of the United States' closest allies, Japan. But in election season, where Pennsylvania is one of the swing states, and Pennsylvania, it's one of the key swing states, and it's home to a lot of U.S. steel workers. It's understandable that the politicians have come out against this. President Biden had indicated earlier he was against the deal, and then Wednesday's news within the last few hours is that he's going to formally announce that he opposes the deal.
It seems to be blocked on national security grounds. I mean, how on earth can the takeover of US Steel by a Japanese company, Japan being a close ally of the US, how on earth can it be a national security risk, this? Surely people don't really believe that, do they?
Well, I think that the national security risk is more a legal basis to block the deal rather than an actual national security risk. I mean, this is just more about trying to keep the plant American-owned, whether that's good economics or not, regardless of whether or not it offends an ally, in this case, a close ally, Japan. And then ultimately it's about votes in Pennsylvania.
I mean, this is bad news, though, for US Steel, isn't it? Because it desperately needs the investments that Nippon Steel could bring to it. There really isn't anyone else around who's going to do that. There could well be severe job losses as a result of this.
Yeah, that's what U.S. Steel has said, that they might have to start looking at closing unionized plants if this deal doesn't go through. So there is certainly a potential economic downside to President Biden's decision. But that will come after the election. The priority is for both Trump and Vance, as well as for Harris and Walz, is to win the election and to win Pennsylvania's electoral college votes. And we see Biden is doing his part for the Democratic ticket by blocking the deal.
I mean, Nippon Steel seems to be going all out to try and convince the government that, in effect, the company will remain American. It will still have American shareholders. It will be a subsidiary of Nippon Steel's US business, which has been in the US for decades. They're going to have Americans on the board of the company. I mean, they seem to be doing everything possible to say this will, in effect, remain an American company, but it doesn't seem to cut much sway with the Biden administration.
And it also didn't cut much sway with the union either. The union has basically come out and said they don't believe the promises Nippon Steel has made with regard to keeping jobs or other aspects of the deal. They've said there are really no true guarantees from U.S. Steel beyond the current union agreements, which expire relatively soon, actually. My understanding is the union agreements with U.S. Steel end in 2026 and would have to be renegotiated then, when everything would be on the table. So the union has continually expressed its doubts about Nippon Steel's promises.
I mean, steel is a very contentious issue, isn't it? Because the US is blocking or has put tariffs on imports of Chinese steel. The Nippon Steel itself is now calling for the Japanese government to block or to put tariffs on Chinese steel, which they say is being dumped on global markets. It seems that steel globally has become a very contentious issue. Is this all down to China and overcapacity?
That's part of the problem with the downturn in the Chinese real estate market. It's clear that Chinese steelmakers do have overcapacity, and they are exporting it to other markets. I mean, the data simply supports that. It shows more Chinese steel is being sold to other countries like Japan or the United States, and that's why the domestic steelmakers in these countries are demanding action from their governments.
And it does seem, doesn't it, that these trade problems are just getting worse and worse. It looks like China's sort of doubling down on its export model to try and revive its growth, and is overproducing in a number of sectors. Those products are being dumped on overseas markets. Those governments retaliate with tariffs. China retaliates with tariffs of its own. It just seems that this is all getting out of hand now.
Well, we're certainly in a cycle of tariff and retaliatory tariff and subsidy and more subsidy across a range of different industries, and we see that in different parts of the world. And for better or worse, certain countries are also in the middle of their or at the beginning of a political cycle, the United States being the obvious example with the election about 2 months away. But Japan, they're entering a leadership change. There could be an early election, even though it's not required for another year. Canada, there was some political news in the last few hours that the New Democratic Party has broken their supply and confidence agreement with the minority Liberal government. So they might have an early election, even though their election was still not scheduled for a year away. In Germany as well, their election is also about a year away, but they might have an early election. So politics is also dominating a lot of the trade discussion in some of the key Western countries as well.
We got Canada, of course. China's now retaliated to its tariffs on electric vehicles and also steel and aluminium with an anti-dumping investigation into canola imports from Canada. And Canada, of course, is the world's top exporter of that. It's used in food and biofuel. China's the world's biggest oilseed buyer. This is now also becoming an issue.
Absolutely. And like I said, within the last few hours, there's been news from Canada that the New Democratic Party has ended their supply and confidence agreement with the Liberals. So, I mean, of course, Trudeau now is going to face the risk of a no confidence vote basically at any time in an early election, which he may or may not want to lead the party. If he leads the party, he might lose. But clearly, they're going to the Liberals, especially as long as they're a minority government, they're going to have to show that they're tough on China when it comes to China trade issues. So the possibility of a trade war between Canada and China is certainly a very, very realistic at the moment.
Do you think this could all calm down once particularly the US elections are out of the way? Do you think maybe cooler, calmer heads will take a look at this and maybe say, well, there are benefits of things like, Nippon Steel investing in our businesses?
Probably not. Again, we're in this cycle of tariffs and cycle of race for who could subsidize desired industries, especially the tech industry. We see the U.S., the EU, Japan with their own versions of CHIPS Act to subsidize semiconductor companies to build manufacturing facilities. So no, we're not going back to the era of free trade, and we'll work everything out in a congenial fashion at the World Trade Organization. And the World Trade Organization is basically broken, especially its dispute settlement mechanisms. And it's just not the flavor of the month in international relations at the moment to go in the direction of more free trade. So I would expect some more of this rounds of tariffs and subsidies, no matter who's governing in the different countries.
So how and where is this all going to end? Because China is making it clear that it's going to retaliate to all these tariffs. It's done that with Canada. It's putting pressure on Japan not to block exports of semiconductor equipment manufacturing machines, and if it does, it's going to maybe put restrictions on the exports of minerals that are crucial to things like electric vehicles and mobile phones. It doesn't seem like this is going to end anytime soon, does it?
Yeah, I have to share your pessimism. I don't think it's going to end anytime soon. And yeah, China certainly has that ability. We have some experience with that years ago when it temporarily banned the export of certain critical minerals to Japan. So there's certainly the possibility of retaliatory measures by China, and I think we have to prepare for that. And regardless of who wins the presidential election, I think we have to expect the next U.S. president to take a number of tough on China trade measures measures. I mean, Trump has he's all but said that he's going to do that. I mean, he's certainly starting with higher tariffs. And I think if Harris wins, she's going to have to take some actions to show she's tough on China as well, even if she's saying she's not going to broadly match the proposed tariffs by Donald Trump.
Where does the red line get crossed? I mean, China says it's not dumping on world markets. It's saying it's just exporting its spare capacity, which countries throughout the centuries have done. You know, you trade by exporting what you don't need yourself. And if you didn't do that, there wouldn't be any trade. So where does it go when it's too far? I mean, China just says it's doing what countries have been doing for a long time. When does it go too far, this process?
Probably is going to have to come down to some bilateral negotiation. I mean, we did see, despite the trade war that Trump initiated with China, there was the so-called Phase One trade agreement in January 2020, which, for better or worse, was not really implemented because the moment they signed it, the pandemic hit, and it's largely gone unfulfilled. So, rather than rely on large multilateral trade agreements, especially in the case of the United States, rather than rely on large multilateral agreements such as the CPTPP, which the United States, even under Harris and certainly under Trump, doesn't seem to, is not going to have any interest in joining. It's probably going to come down to bilateral negotiation, like the Phase One trade agreement that the U.S. had with China in January 2020. So they're probably going to see we'll probably see initiation of higher tariffs and trade wars and retaliation, and then that'll be followed by bilateral negotiation, where each side can make a deal with regard to specific products, but that still leaves the possibility that they'll have a deal with regard to specific products with their other products. We're going to see retaliatory rounds of higher tariffs.
And the problem is China doesn't seem willing to back down in any way, does it? President Xi Jinping is determined to go with this export-driven model. And what competitors say is that where this is unfair is because of the huge amounts of subsidies that China is ploughing into its state-owned companies, which just means other companies around the world can't compete.
And that gives other governments around the world a basis to say that we're initiating anti-dumping or countervailing duties on dumped or highly subsidized Chinese products. So it's going to continue to influence the cycle, but it doesn't seem likely that Chinese policy is going to change either. It seems that they're more willing to take the risk of having higher tariffs imposed on their products in the belief that they're still going to be price competitive even with higher tariffs.
Ross, thank you very much indeed.
Thank you.
That's Ross Feingold, who is Director of Research at Caerus Consulting in Taiwan.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you for listening to Money Talk this morning. Do please take a look at my newsletter at peterlewismoneytalk.substack.com for more information on Asia's business and finance news. I'll be back tomorrow when I'll be joined by Francis Lund, the CEO of GEO Securities, and Mark Franklin, Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investments. With a view from Australia is Toby Lawson, the CEO at Staten Partners. Have a good day.
Money Talk.